Hi everyone, I'm Tim Hill, a BC registered mortgage broker right here in beautiful North Vancouver. If you're thinking about buying a home in Canada, or you already have a mortgage, you've probably heard the word amortization thrown around. But do you actually know what it means and why it can save or cost you tens of thousands of dollars? Today, I'm breaking it all down for you. What amortization really is, how the length you choose affects both your monthly payments and the total interest you'll pay, and the important Canadian regulations around mortgage insurance and amortization periods. By the end of this video, you'll know exactly how to make the smartest choice for your family's budget. Let's dive in. First things first, what is amortization? Simply put, the amortization period is the total number of years it will take you to completely pay off your mortgage if you make only the minimum required payments. In Canada, the most common amortization periods are 25 or 30 years, but you can sometimes go shorter, like 15 or 20 years. Here's the key thing most people don't realize. Your mortgage is made up of blended payments. Every month you pay both interest and a bit of the principal, the actual amount you borrowed. In the early years, the majority of your payment goes toward interest. Over time, more and more goes toward paying down the principal. That's why an amortization schedule is so powerful. It shows you exactly how your loan gets paid down month after month. Think of it like this. You're not just borrowing money for 5 years. That's your mortgage term. You're spreading the repayment over 25 or 30 years. The term is when you renew or renegotiate your interest rate. The amortization is the full payback clock. Now let's talk about the big question. How does the length of your amortization affect your monthly payments and the total interest you pay? The shorter the amortization, the higher your monthly payment, but the less interest you pay overall. The longer the amortization, the lower your monthly payment, but the more interest you end up paying in the long run. Let me show you with real numbers. Imagine you're buying a home and you need a $400,000 mortgage at a 5% interest rate. A pretty realistic scenario in today's market. If you choose a 25-year amortization, your monthly payment is about $2,338. Over 25 years, you'll pay roughly $300, $1,500 in interest. Now stretch that same mortgage to 30 years. Your monthly payment drops to about $2,147. That's $191 less every month. But over 30 years, you'll pay about $373,000 in interest. That's an extra $71,500 in interest just for the privilege of lower payments. And interest rates make this even more dramatic. If rates are at 6% instead of 5%, a 25-year payment jumps to $2,577, and total interest climbs to $373,000. A 30-year payment is $2,398, but total interest explodes to over $463,000. That's why choosing the right amortization is honestly one of the most important decisions you'll make. Shorter amortizations are great if you can afford the higher payments. You build equity faster and save a fortune in interest. Longer amortizations help you qualify for a bigger mortgage or keep your monthly cash flow comfortable, especially in high-cost areas like Greater Vancouver or Toronto. But you do pay for that convenience with more interest over time. Okay, now let's talk about something that's unique to Canada, how amortization interacts with mortgage insurance regulations. In Canada, if you put down less than 20% on your home purchase, your mortgage must be insured by CMHC or one of the other approved insurers. That insurance protects the lender if you ever default, and the premium gets added to your mortgage. Here's the important part for amortization. CMHC and the federal government strictly limit how long your amortization can be on insured mortgages. As of right now in 2026, the standard maximum amortization for most insured mortgages is 25 years. However, since December 15, 2024, first-time homebuyers and buyers of newly constructed homes can now access 30-year amortizations on insured mortgages, up to a $1.5 million purchase price. That change was huge for affordability. It lowered monthly payments for thousands of young Canadians and new build buyers. Why the cap? The government wants to make sure borrowers don't take on too much debt for too long and to keep the housing market stable. If you put down 20% or more, your mortgage is uninsured, conventional, and many lenders will still allow up to 30 years, sometimes even longer depending on your situation. So the down payment percentage you choose literally opens up or closes down your amortization options. One more quick note, that CMHC insurance premium is usually between 0.6% and 4% of the mortgage amount and gets added to your loan, which slightly increases the amount you're actually amortizing. Your broker will calculate the exact impact for you. So, what should you actually do? Here are my top 3 pro tips as a BC mortgage broker. First, be honest about your cash flow. If lower payments let you sleep at night and still hit your other financial goals, a longer amortization, especially the new 30-year insured option for first-timers, might be perfect. Second, run the numbers both ways. I always show clients the 25-year versus 30-year scenarios side by side, so they can see the monthly savings versus the lifetime interest cost. And third, remember you're not locked in forever. You can always make extra payments or refinance later to shorten your amortization once your income grows or rates drop. The best amortization period is the one that fits your life right now, not what your neighbor chose. There you have it. Everything you need to know about mortgage amortization in Canada, in plain English. If you're buying your first home, renewing, or just curious what you can afford, I'd love to run the exact numbers for your situation. No obligation. Drop your questions in the comments or visit timhill.ca to book a free 15-minute call. Thanks so much for watching. If this video helped, please give it a thumbs up, subscribe, and hit the notification bell so you never miss a Canadian mortgage tip. I'm Tim Hill, your BC registered mortgage broker, and I'll see you in the next video. Take care.